Our club has always been a forum for public figures, thought leaders, and decision makers to share their ideas. Here, we offer access to dynamic political, business, and public personalities.
We are dedicated to encouraging debate on the issues that matter to this city, this province, and this country.
The Canadian Club is one of the most important podiums anywhere in the world that a Canadian can speak to, tell Canadians what it is that they think, develop those thoughts. And so I want to thank you for that very, very much.
Please join me in thanking our esteemed panelists today.
Through our programs and events, including our youth and young leaders programs, our diversity partnerships, our joint events, and our media and social media opportunities, we offer you access to dynamic political, social, and business figures from abroad and right here at home.
The platform from which the eloquence of Canada has flowed all of that time, whether it be business, education, politics, sports, arts, and culture. If someone wants to say something to Canadians about this country and about the future of this country, this is the venue you choose.
Good afternoon, everyone. My name is Colleen Kennedy, and I'm the Executive Director of the Canadian Club Toronto. While we meet on a virtual platform, I would like to acknowledge the Indigenous peoples of all the lands that we are on today. Let's take a moment to acknowledge and recognize the importance of these lands, which we all call home. We do this to reaffirm our commitment and responsibility to improving relationships between nations and improving our own understanding of local Indigenous peoples and their cultures. We are grateful for the opportunity to be able to come together to learn on a land. Well, when it comes to Ontario's public sector investing, there is a wide spectrum of size, capability, and performance. Does size matter? Is there enough value for stakeholders? Amongst the billions of dollars in investment, is money being left on the table due to size and purpose? Today's speakers will answer these questions and more as we host the CEO of Investment Management Corporation of Ontario and the CEO of CEM Benchmarking. Before we hear from today's speakers, I want to review a few housekeeping messages. The click here to switch stream button helps if you find that your internet is slow or it's clipping. You may have worse video, but your audio will be much better. If you click on the questions tab, you can enter your questions in the window and it will be sent to the moderator. And I'm sure he will be excited to hear your ideas and questions. The request help button located in the bottom right corner of the page is for technical support. I want to take a moment to thank our sponsor for helping to make today's event possible. Thank you to the generous support of Stikeman Elliott. Today's important conversation is available free of charge, and a recording will be up on our site this afternoon. The Canadian Club is a nonprofit, and we have been gathering people together for 125 years. And it is because of our sponsors, partners, and members that we are able to continue to do so. So thank you for your support. And now today's speakers. Bert Clark is the President and CEO of the Investment Management Corporation of Ontario, overseeing the organization's strategic direction and global growth so that it can meet the long-term financial objectives of its clients. Rashay Jethalal is the CEO of CEM Benchmarking, and he is responsible for overall strategy and performance of the business and brings more than 20 years of experience in financial services to the discussion today. We are delighted that we are joined by Jim Leech, Chair of the Advisory Board of the Institute for Sustainable Finance, who will moderate today's important discussion. Lastly, a tradition that our club maintains today, even though we're virtual, is the toast we make to our country. If you have a beverage close by, please join me in a toast to Canada. To Canada.
To Canada.
And now, over to you, Jim.
Thank you very much, and good afternoon, everybody. Welcome some 300 and some people who have chosen to join us for this hour-long discussion. I'm I thought I'd start off by asking both Bert and Rashay to talk a little bit about their own background, personal. Make that short, guys. And then, but tell us a little bit more about your organization. So, Rashay, why don't we start with you? I'm sure not everybody has heard of CEM benchmarking. So, give us a background.
Thanks, Jim. I'll start with CEM. So CEM is exactly, it's a data and insights firm founded about 30 years ago. And the reason our team gets up in the morning really is to improve the lives of members and pensioners around the world. And we do that in a few ways. We collect proprietary data from over 1,100 funds around the world, including 150 of the top 300 by assets under management, by AUM. We ingest it, and then we provide funds around the world a perspective on how their performance is doing. You know, are their members getting value for money in investments? Are they getting value for money in the services provided to the members? And this database also allows us to do a bunch of custom research. And we tend to publish, you know, a few times a year, a piece that we think will be helpful to the industry at large. And we try to do it from an empirical base. And so that's a little bit about CEM. And look, I've been CEO since October, and my background, as Colleen kindly mentioned, is in financial services, including being a consultant, working with a number of the pension funds, working at a couple of the Canadian banks, and most recently helping run a retail asset manager.
Great, thanks, Rashay. Bert, over to you and IMCO.
Thanks, Jim. Well, as Colleen mentioned, I'm the president and CEO of IMCO. We manage $75 billion on behalf of 4 public funds in Ontario. Our mandate is to provide our members with an end-to-end asset management solution, which includes advice on their asset mix, better access to investments than they could achieve on their own, high-quality risk management and reporting. We were created in 2016, and that's when I joined IMCO. You can think of us as Ontario's version of BCI, AIMCO, or the Caisse de dépôt. And that we have while we manage 4 funds today, our mandate is to attract small public funds in Ontario to join to provide them with better access to investments.
Super. And a little bit about yourself?
Oh, sure. I'm a dad, 4 kids, 2 dogs. Thankfully, none of them are here, and one of them is here, and hopefully she will not run in today. I've had a career that's spanned the public and the private sectors. I managed an organization called Infrastructure Ontario before joining IMCO. I've also been a lawyer and an investment banker.
We won't hold the last 2 against you anyway. So I thought what we do today is I prepared some questions and address them to one of you, but the other, please feel free if there's something to add, or maybe we can have some color here, and maybe you want to disagree. Please don't hesitate to respond to the question as well. And for those of you in the audience, there is the ability to submit questions which will somehow magically make their way to my telephone. And I will try to incorporate them as we go along. So the first question I had was for you, Rashay. And you know, earlier this week you released a report. I think it's up on the website or was sent out to most participants. And you talked about how you do proprietary reports. Tell us a little bit about the report, how you went about it, and what its principal findings were.
Yeah. So we set out to answer, actually, and we do this with a degree of frequency. We set out to explore the question of, you know, how can institutional investors improve their long-term risk-adjusted return? Like, is there some secret sauce behind consistently delivering better results? If you're a pension fund or a sovereign wealth fund, in our database is both public and private, it's both defined benefits and defined contribution. And we were looking to see, is there a dominant theme we should be putting to the forefront? And this is against the background of a lot of opinion in the market. You know, depending on who you talk to, some will say, maybe you need to pick certain asset classes, or maybe it's certain types of investment professionals, or maybe it's a thematic approach in one area or another. And so, our team dug into effectively 30 years of data. And what they did is they examined, again, $11 trillion of assets to figure out, is there a way of consistently outperforming? And what we found was, actually, it was really interesting. We found that the larger the funds are, and we segmented between under $1 billion, 1 to 10 billion, and greater than 10 billion, the larger the funds are, the more consistent outperformance on both a gross and net basis, and we can get to some of the details, you will find. And it's an enduring finding. So over 20 years, we looked at the top of the market, we looked at the bottom of the market, we looked at different geographies, and it's a finding that holds that scale really matters. And then the second piece that I'll just add to it, and then we can go into more detail if you'd like, is that, and it's also not driven by taking more risk. In fact, you can achieve greater return, and large funds do achieve greater return, and they take less active risk at the same time. And so to us, this is the kind of empirical finding that we hope cuts through the noise. We think it's a very big deal, and I can get into some of the reasons as to why we think it's a big deal. But the headline is, size does absolutely matter, empirically proven, and you can deliver that without taking more risk. In fact, with taking less active risk.
And looking at your report, you talk about the sort of most important quantitative features of the funds were their active management, internalization, and economies of scale. You touched on the economies of scale. Can you talk about the other aspects too?
I'm happy to. And actually, Jim, just before I did, do you mind if I just contextualize how big a deal this is? Because I think for everyone who's listening, it may help a little bit. And then I'll talk about the three factors.
Sure.
When we looked at the differences in the return, we started by looking at the top line, right? So if I am going to achieve a result above a benchmark, so my gross value add, what is that and what would it be? And if you look at larger funds, so north of 10 billion in assets under management, again, they delivered consistently just over 80 basis points, so just under 1% of gross value add. And if you looked at smaller funds, less than $1 billion, it's still positive, but was closer to 50 basis points of value add. So that is great. They're beating their benchmarks. What gets interesting is when you look at the dollars that actually land in an investor's pocket, so the net value add, which subtracts all the cost of investment from it. And what you find there is after costs, again, dollars landing in my pocket, the big funds are actually delivering 30 basis points of return. And the small funds are actually slightly negative at -3 basis points of return. This means if you're big, you're consistently delivering 30 basis points of return. And we can talk about the risk profile. To your point, Jim, a lot of that is driven by internalization. So bringing some of your investment management professional expertise in-house, right? A second piece is by taking active management strategies. So actually trying to deliver absolute returns rather than just trying to beat a benchmark and track to it as closely as possible. And then thirdly, just economies of scale in the way you manage the fund. And that last one I find easiest to explain with an example. And so if you look at larger funds in market, trying to manage, for example, an active US equity portfolio, I'll use some numbers because it'll make it a little bit easier. If you're managing about 200 million of US small cap, you're probably paying, our data shows, about 55 basis points. But if you were a $2 billion fund for the exact same management, you're probably paying 40 basis points. So just by virtue of being larger, your costs decreased by 30%, right? And so the active management of internally managing things, using a team of professionals, and then just leveraging your scale as it pertains to your cost basis. And actually, it pertains to your internal cost basis as well. Your FTEs don't grow at the same proportion as your AUM, so you actually get scale benefits there too. That drives a lot of the 30 basis points in net value add we see.
Sort of sounds like the Canadian model.
It does indeed.
And Bert, you were created, in fact, to be one of the Canadian model firms. So why don't you give us your take on this report and what you get out of the report or read as a big manager?
I completely agree with Rashay. It is big. It's a hugely valuable contribution to the investment management space. I was really struck by two things. The first is, whether you're -3 basis points or positive 30 basis points, we're not talking about a ton of basis points here in the context of the types of returns that most investors are targeting. And so it's a good reminder that while NVA is important, what's really important is getting your asset mix right, making sure you're matching your liabilities, making sure that you're managing your liquidity well. And sometimes, the asset management industry, I think, loses track of that. There's an obsession with NVA. Not to say it's unimportant, but I think you have to put it in context, and this report does just that. The second thing to me that I thought was so interesting about the report is, as an investor, there's really two types of strategies in my mind for increasing your returns: those that do so by increasing your risk, and those that don't. The things that increase your risk and returns, or are likely to over time, are things like owning more equities as opposed to government bonds, or adding leverage, or buying illiquid versions of assets. And those are very common techniques, and they're used by most investors, and they make sense over the long term. But they all increase risk. The range of outcomes is wider once you employ those. There's a smaller list of things, though, that improve returns and don't involve taking any more risk. People talk about the free lunch of diversification, so building a better portfolio. Costs, I'd put in the same category. Costs are a free lunch. If you can get your costs down, you immediately have better net returns, and you haven't taken any more risk. And I think, sadly, a lot of those, let's call them risk-free return enhancing strategies, are only available to bigger investors. And so smaller investors are left to pursue higher risk strategies to increase returns. So I thought as Rashay said, this is big, and a huge, to get the numbers out there and the facts is hugely valuable.
So you were created, IMCO was created to, on the principle that amalgamating smaller funds would enable those funds to get better returns for their clients, whether whatever they are, pension plan or whatever. And so how many funds, let's just take Ontario. How many funds are there that are kind of suboptimal? So small, under $1 billion or less.
There are 80 funds in Ontario, public funds, so they'd be eligible to join IMCO, that are sub $1 billion. A number expands if you expand to under $10 billion. And that's the under $1 billion is about $25 billion worth of funds currently being managed by what I call subscale organizations today. Most of them, frankly, were not set up to manage money. They ended up managing money over time. They were a university that ended up with a pension fund, or a crown utility that ended up with a pension fund, or a municipality with a reserve fund. So there are huge pockets of public funds today being managed by organizations that are subscale and not in the asset management business. Huge opportunities.
Okay, great opportunities. What are the roadblocks? Well,
we didn't exist until 2016, so there was actually no place for them to go until 2016, and so until recently there wasn't an option. Now that they exist, now that we exist, there is an option for them. The challenge is, public sector organizations don't make decisions quickly, and I don't mean that as a criticism. They don't, and we probably don't want them to. Deciding to move all of the funds you manage from from you to someone else is a big decision. And so it's a decision that most of them are moving slowly on, but they are moving. So for instance, in the fall, the city of Ottawa voted to have us manage their funds. We're now managing the Judges of Ontario's fund. They're a new client. There's at least 2 more government agencies that will be announced in the first half of this year. So it's happening, but these are big decisions. The other, oftentimes there are also regulatory or legislative barriers, and so we're having to work closely with the government to remove those to allow them to join.
Gotcha. So, what about the issues of you hear people say, well, yeah, but my fund is unique. We have a separate set of a unique set of liabilities. It's very different managing the judges from managing the Workmen's Compensation Board, et cetera. I mean, a different set of liabilities, different set of issues. How do you, and this is to either of you, how does that amalgamation take place when you're trying to aggregate these funds?
Rashay, do you want to?
Bert, why don't you go ahead? Because I want to expand this a little bit to the private sector as well, but I don't want to ruin this thread. So why don't you go ahead and then I'll jump in afterwards.
Yeah, okay, Jim, that's an entirely fair point, I think, to say, well, not all liabilities are the same, and I completely agree. Going back to my first point, your asset mix should reflect your liability. You should have an asset mix that's bespoke, and all 4 of the clients we have very different asset mixes, and so the way IMCO is set up, we have a series of pools, and clients can invest in them in the proportions that reflect their investment return objectives and risk appetite. So I think it's fair for them to want a bespoke solution for their investments. The things that Rashay has pointed out today, or in the report, the advantage of scale, those apply no matter what your liability. No matter what your liability, it's better to have lower costs. It's better to invest in the systems that allow you to understand what you're investing in. That's not at all affected by your investment objectives.
It's true. And Jim, you asked why haven't more funds consolidated effectively? I'm paraphrasing. This is actually where I think the data matters. Like, I think there are so many reasons to not do it. And unless you're deeply informed by facts that goes back in time, I think there's enough reason to create pause that you may not do it otherwise if you're a fiduciary or plan sponsor. And I just want to add a couple points so that Bert and I totally see this the same way. I mean, we're talking about 30 basis points in value. And so we're talking about $1 billion of funds. And I just want to contextualize this a little bit. 30 basis points on a $1 billion fund is $3 million in value a year, which may not seem like a ton, but over a 30-year horizon, which many of these funds have for individuals at their funds, that turns into about $100 million in incremental value accrued to the fund. So a $1 billion fund could be $1.1 billion. And Bert's made exactly the right point, which is this is effectively the free lunch of diversification. You get this by taking less risk. And I think there's a bunch of people on this call who might be more on the corporate side as well. In Ontario, we have, if I include the corporate side as well as the public side, almost 1,000 DB plans, $1 billion or less. And if I'm sitting on the corporate side, I sit and I think I worry about this being a liability to my company, right? If we don't get the funding right, my company will have to either fund the shortfall or take that risk as it occurs. And so, we go back to why haven't more of these funds consolidated? I do think the numbers haven't really been played out to the market in a way that's clear. We hope to be doing that here. And I would point out that in other jurisdictions, like the Netherlands, like Australia, like the UK, they've already traversed down this path. Like, if I look at the Dutch, and I'll use the Dutch as an example, We did some work where we looked at the number of DB funds in the Netherlands. And, if I go back to 1997, there was about just over 1,000. And by 2015, that number was down to about 250 to 290. And so you saw the growth, the benefits of scale be realized in a market that's actually quite sophisticated. If you look at the UK, you can see the local government pension scheme encouraging consolidation to 7 or 8 larger asset pools. And if I move from even defined benefit to defined contribution, which is a different beast altogether, but I look at Australia, they have a superannuation system put into place where the public side has outsourced management to the private side. And even there, we're seeing a whole rash of mergers. And so, it's one thing for us to do the numbers empirically. It's another thing to look at the market and say, is this existing in nature? Is what Bert is doing at IMCO, is what people are doing across different provinces like KES and BCI and IMCO, does that exist in nature? And absolutely it does. And so we actually think that this is the beginning of a journey, which will see much more consolidation take place.
Yeah, I can chime in there, Rashay. I hope that as the various fiduciaries overseeing these funds, absorb these facts, they start to recognize that, they've got a choice to make here in terms of, they can either enhance investor returns by taking more risk, or they can do things that, are risk reducing, or at least risk neutral, and enhance returns. And as a fiduciary, to me, the choice is pretty obvious, but we needed to get the facts out there. So I think kudos to CEM.
Good. I just remind the public again, if they've got some questions, please send them in. I know there are lots of experts on the line as well. So one question's come in about private assets, and let me lead into that by saying, as I read the report, that's an area where by moving it in-house more and effectively disintermediating the private equity firms, that the net returns can be substantially enhanced. First of all, is that correct, what I'm reading there? And secondly, is that a risky strategy? I mean, can you afford to keep the people, to pay the people, to assemble a team that can take on KKR or Onyx, who have been doing this for a long time and built up teams and built up market presence? So I don't know which one of you wants to take that one on.
Bert, do you want me to handle the numbers and you can then talk about building the team?
Yeah.
And so, Jim, we did look at the performance of both large and small funds, rather, with the inclusion of 2 of the private equity and real estate, and then also with the exclusion of private equity in real estate. And the short answer is, yes, it absolutely does matter to have real estate and private equity added to your program. We do see enhanced gross value add, and we actually do see diversification benefits. There is a little bit of, it's interesting because as you get into private asset classes, you do have to make sure the comparisons are apples to apples from a benchmark perspective. But when the addition of real estate and private equity does materially increase your gross value add and decrease your overall active risk at the fund level. Now, the one thing I think that's important to say here is, you do need scale to do this properly. It's not available to every fund to have an internal team in private equity, for example. And so, just to contextualize this, the smallest fund in our database that has an internal private asset class or private equity team of scale is just under $20 billion in AUM. And the second largest is actually just about 35 billion in AUM. So you actually have to be pretty large before you can have that team internally. And I think it speaks to the effort required in building the right team and right systems as well. I think Bert's really well placed to talk about that. So let me turn to him.
Sure. Let me just step back. I mean, we are big believers in investing in private assets. We have a private equity team, private infrastructure, real estate. credit, increasingly credit also. Private companies in some ways are no different than public companies. They hire people in the same societies and they sell goods and services to the same consumers. But the public markets are set up for certain types of companies. There are continuous disclosure requirements, and if you're rated, rating requirements. There are lots of companies with great ideas, great business plans that can't access the public markets, or that's not the most efficient way for them to do that, and so they access capital in the private markets. Obviously, if you're investing in a private company and don't have an ability to trade those securities on any given day, you should be paid something extra for that, and hence the illiquidity premium that people talk about. I guess a couple caveats. One, investing in private companies doesn't guarantee you a premium over the public companies. If you look at the FANGs over the last 5 years, they've massively outperformed the S&P, and by amounts you wouldn't expect, even if you're investing in private equity. The second thing is the point Rashay made, which is it's not easy to access private investments. They're not readily available. And so typically people invest through funds, and certainly smaller investors would invest entirely through funds. The fees that you pay to invest through a fund may well eat up all of the benefit of being in that asset class, is the reality. And so if you're going to invest, you need to find ways to partner with the best partners, and get those fees down. And your scale typically allows you to negotiate the fees down. That also allows you to co-invest alongside them in select transactions. So the model we've built around all of our private assets is to identify the best private investors in each asset class, to establish strong relationships with them, and then to selectively invest alongside them. So back to your question, I guess, Jim, are we competing with KKR and Onyx and others? No, generally not. Generally, we're investing in the best funds and then investing alongside them. That we have, I guess, something we would call a hybrid model. We're not 100% internal, but we're not 100% external. We think there are real benefits to that model.
I guess the advantage there is that by investing alongside these people, you effectively bring your average cost down. So you're not paying the infamous 2 and 20 on the entire investment you're making. You're paying 2 and 20 or whatever you've been able to negotiate on that part that's in the fund, but significantly less, if anything, for the addition. So if you're 50-50, you've effectively half the cost. Is that the?
That's exactly right. If you're paying 2 and 20, I'm not sure you're going to outperform the public markets, and you may be taking more risk. And so you need to figure out a way to get those fees down. And as you say, if you're bigger, you probably negotiate the 2 down, and then for the funds you invest with them, and then you try and invest beside them selectively on individual transactions on what they would describe as a no fee, no carry basis. And when you average your fees, you're now getting down into way less than the 2 and 20, and you can actually see the benefits of investing in private assets.
But I would suggest you also likely still need a knowledgeable team to be able to make judgments on those co-investments in particular, to avoid adverse selection.
No question. To pick the best partners, you need people who've actually done it, and then to co-invest alongside those investors, you need teams internally. Absolutely.
So one of the questions that's come in from the public is when you said that the larger funds can get better returns by, but at the same time lowering risk, volatility, etc. One of the questions that's come in from the audience is that partly because of the lag in valuations, or in effect smoothing of private asset valuations, and that really leads to the question of the rigor around private asset valuations, and maybe you can comment on that, Rashay.
Yeah, I'd be happy to. I want to just add a couple pieces in this conversation because I think they're really important. We spoke earlier about, when we saw large funds, and I'm going to come to your answer in a second, I promise, Jim. When we saw large funds have 30% or 30 basis points more net value add, we initially thought maybe that is taking a bit more risk. And I've shared with you, we looked at the standard deviation of returns and realized that's not what it is. We also thought it might just be you have better investment professionals. Like larger funds might just be able to hire better and smarter people, right? In what we did, and I'll come to private asset classes because I think that's important. But if you actually look at public asset classes, the gross value add is actually the equivalent, whether you're large or small, in all of the public asset classes, which does start to speak to, this isn't you're hiring better investors, right? Where the real difference comes in is in the savings of cost below a line that looks roughly the same if you're large or small. And to Bert's point on the private side, you do see more return, superior return in private equity, private asset classes for the large funds, but many of them give it away in terms of what they pay for that gross return. And so being diligent about how much you're spending to achieve that is actually critical. And to address this question directly that you just asked, Jim, about whether it's smoothing by virtue of private equity within it, it is actually not the case. Private equity in the private asset classes actually comprise a small percentage of the overall AUM, and we do use a custom benchmark to then look at it. And so we feel comfortable asserting that the 30 basis points of net value add is at a total fund level, inclusive of all asset classes, and is not driven by a particular leg within one of the smaller asset classes, private equity, which can be 10 to 15% on the higher end of some funds, is actually representative of the entire fund as a whole.
So this one's also from the audience for you, Rashay. You mentioned that the largest AUM category in research was above 10 billion. And the question is, do you have analysis to show the impact of scale on costs going from, say, 10 to 100 billion? I think what they're really trying to get at is there diminishing returns? Is there a point at which you're too big and it costs you to be too big?
Yeah, it's a great question. And it's one we tried to explore a little bit. And so the short answer, Jim, is the data does not support diminishing returns at the higher end. Now, the reality is we don't have an infinite universe of 250, 500 billion and $1 trillion funds in there. But there's nothing to suggest on a cost basis that the value does diminish as the funds get larger and larger.
Maybe Jim, sorry, Rashay.
Yeah, no, Bert, go ahead.
So this is, I don't have the data, so this is all anecdotal, but our first two clients joined us when they each were managing about $25 billion. So significantly more than the $10 billion in the study. And they both concluded that they weren't able to do what they knew they needed to do to better manage those funds. So it's certainly, they came to that conclusion. I would say that cost scale, I'm not sure opportunities do. I do think there's a point at which, and by the way, I don't know what that number is. I think it would become harder. There are just only so many. If you're going to be a focused organization, try and be good at a certain number of things, have a limited partner roster. At some point, there are only so many good opportunities. So I think the opportunities may not scale, but the costs may. So the benefits diminish.
Yeah, and I should have made one other point here, Jim, which is I'm presenting the research as though it's three discrete buckets, like sub 1, 1 to 10, and 10 and above. But that's not actually what we did. We actually regressed it all the way up to the largest funds in the group. And the regression does apply. I don't want to get too far into details. I know that's not the point of today. But the regression applies all the way up to the largest funds, right? We sliced it to explain it, but the findings are true all the way up, right? And so And so the second point I'll just make is, but there might be non-economic reasons some countries and institutions have chosen to split above a huge threshold. But those are not usually driven by net value add or economics. They're usually driven by other motivations.
Yeah, like Sweden, for example, split their funds into S1, S2, S3, et cetera. And then they talk about putting them back together again all the time. So who knows? For either of you, you know, when I was in the business, the Americans have a lot of very large funds, and yet they never appeared in the top list of returns and of performance, and yet they were large. And so why?
You know, to me, there's really one answer, and that's governance. I think one of the signature features of the Canadian model was that the biggest funds really operate at arm's length from governments with professional boards and professional staff. And, you know, that allows them to take advantage of the opportunities that scale presents. And really, as we've talked about a bit, that means internalizing. The common phenomena you get in the United States is that because you have, you know, lay boards, there's this obsession with operating costs. We need to keep salaries low. We need to keep our internal costs low. And meanwhile, they'll be paying, you know, huge amounts of fees to external managers. And so they're not seeing any of the benefits of scale. They could, but it would involve, as you say, adopting some of the, you know, Canadian model practices, which is to have a professional board and professional internal managers.
And there's an interesting thing going on here, Jim, which I think you're comparing large US funds to large non-US funds, right? In some part. Right. If you actually take the US market and look at large US funds versus medium US funds versus small US funds, many of whom have similar governance issues, particularly in the public sector. Yeah. You know, the large ones are still outperforming the medium and small ones. It's just the degree of differentiation. Like, we have different performances here than we do in Canada or in Norway or in Australia than you necessarily see in the US. And so I do think it's slightly different. And one other point in here as well is, look, whichever market you're in, you tend to be biased towards investing in that market by either policy or what have you. And the reality is the US large cap segment is the most efficient market in the world, right? And so if you're going to be trying to create net value add, that's actually the hardest environment to do that as well. And so that does drive a little bit of it.
That's good. You're defending your clients in the States. That's good.
Well, and actually, you know, can I jump in? There is one other small constituent I do want to defend a little bit here, which is the small fund, because I know it's easy to come away from this conversation, I think, and say, why do we ever have small funds? Like, how does this even exist? And I do think it's worth just contextualizing that, you know, many of the small funds that exist, the sub-billion-dollar public or private sector funds we're talking about, in many cases, they're better than the alternative, right? Like, many of the organizations they work for might not have even had a pension fund. And so individuals may not even have invested for themselves, or, you know, they may have had, you know, expensive, and I will take a bit of a swing here at the investment advisory community, because it can be more expensive to have an investment advisor or to be buying, you know, assets on your own. And so this is better than that. Like, being a sub-billion-dollar fund with a -3 basis points net value add is superior to anything you can do in the retail space. Like, if I'm buying low-cost ETFs, I'm still paying, you know, the lowest cost ETFs, I'm still paying 5 to 10 basis points just for that, plus transaction fees. And so and if I have an IA, it's significantly more than that. So I'm still doing better than that, right? And so there's a reason they exist. We just think it's compelling. And if I was leading a small pension fund, I think I would step back and say, does this data, again, we're data driven here. Does this data give me reason to consider consolidation? Like, if I look at this, shouldn't I be thinking about it, right? And I think at minimum, if you're, a fiduciary at a smaller fund, I do think you should look at this and say, there's clearly facts in existence now, clear definitive facts that say bigger is better. And I do think that conversation is required, but I don't want to necessarily say $1 billion or below is a bad thing. It can be relatively better than the alternative.
So one of the hottest topics for the last number of years is ESG, environmental, social, governance issues for investors, and all institutional investors are turning themselves inside out to look at the carbon footprint of their portfolios, etc. If I'm a smaller fund going into looking at congregating with others, amalgamating with others, so to speak, or aggregating my funds, because they'll still be my funds, how can I be assured that, and I'm, I really am very concerned about ESG issues. How can I ensure that I'm going to be able to satisfy those desires of my beneficiaries? Bert?
Yeah, I think people are right to be, as you put it, turning themselves inside out on these things. ESG can mean a lot of things. I'll tell you what it means for us. It means placing importance on diversity, equity, and inclusion. It means really taking governance seriously for the companies we invest in, and then finally it does mean ensuring that the companies we invest in have a plan around carbon. So that is part of every investment we make, every manager we hire, every direct investment we make. Rashay may have the data. For me, this has now become common sense. 10 years ago, maybe these were individuals' objectives. Today, I think, and it's certainly been my personal experience that more diverse, equitable, and inclusive organizations perform better over the long term, and that's also true for governance. And in terms of the carbon footprint of companies we invest in, the world is changing. There is an energy transition that's beginning. It's happening, and I think any company that doesn't have a plan around reducing its carbon emissions is going to soon. And we'd probably worry about companies that aren't thinking about that in the same way I'd worry about investing in a company that didn't have a plan around digitization or globalization. This is real. I think there are going to be huge opportunities and huge risks associated with this energy transition. I think it's another area, frankly, where size does matter. I think the easy ways to decarbonize your portfolio will reduce risk. It will also significantly reduce returns because they're available to everybody. The opportunities to invest in helping convert the economy to a less carbon intensive economy, those are going to be available to bigger, more sophisticated direct investors. I'll give you one example of what that looks like. Over the course of the summer, we invested in a utility scale battery business in the UK, where we bought a bunch of peaking diesel plants, which obviously doesn't sound very green or environmental, but the plan was to replace them all with batteries, which we're doing. Well, that's the kind of thing that small funds aren't able to do. I mean, we set up a company, a wholly owned company, to do that. Small funds can decarbonize, but they're rushing into a very crowded market. And so I think again, if that's a priority for small funds and they want to do it in a return positive way, they're going to need to look at scale.
I would completely agree. I mean, and I'm going to give you a little bit of data behind it. I mean, it's a hard place to get specific data because definitions aren't super good yet in the ESG space, but absolutely, we believe and we see the clients who are most able to affect ESG mandates are those who are able to make direct private investments. And the reality is, the larger you are, the more you can do in the private space at scale. And look, we tried to think about this a little bit in a separate piece of research. And we went back to the PRI, the Principles for Responsible Investing. I think most people are familiar with it, but founded in 2005, 6 principles that signatories would commit to follow. In our database, we actually have about 70 clients who have signed, about 40 of them for more than 5 years. And the things I can say, actually, there's 2 interesting things. One is the returns from those funds have largely been superior for signatories versus non-signatories, which is a good thing. And the second thing is the costs haven't gone up because they've signed it. I think there's a nature, people think, oh, if you sign it, it's going to be more expensive. And actually, almost counterintuitively, costs are actually lower for those who are signatories versus those who are not. Now, there is a scale piece at play here, so I don't want to discount that. But all the evidence points to scale does actually matter in the ESG space as well, right? And so I think it's an important point just to link back ESG to scale.
So, Bert, what I hear you saying is that as a large fund, you have sophisticated ESG policies, strict, that follow them. So, if I'm a smaller fund with some real conviction and maybe even some expertise in the areas of ESG, am I comfortable going with you?
You will be very comfortable being with us. Yeah, it's something. It's one of our core investment beliefs is that taking ESG seriously leads to better long-term results. So it's a part of every investment decision we make. As I said, whether that's hiring a manager or making an individual investment, it is hardwired into the organization. By the way, it's important to us. It's also really important to our existing clients. They're as passionate about this as us. And I'd say if you're small and passionate about this, and you really do want to succeed in a world where the energy transition is going to lead to big risks and big opportunities, scale is required.
So 2 last questions as we're coming up on the hour. One was actually a specific question, Bert, about IMCO. But I think we can generalize it. When you're trying to aggregate like this, do the clients become captive, or can they leave at some point? And how do you handle that?
Yeah, theoretically they could leave. I mean, we would have failed if they do. And so one of our core strategic objectives is to meet and exceed our clients' expectations. And so something would have had to go wrong. We're a client-based organization, but we're a voluntary organization, and so we work every day to make sure that our clients are happy in terms of investment results and service.
So talking about service and this, because I know Rashay, you on another part of what CEM does. Yeah. And an advertisement for CEM, certainly when I was in the business, I mean, you guys are the definitive place to get data. I mean, you know more about what's going on in the pension plan industry in the world than anybody else does. And kudos to the company that doesn't have a huge profile in the business community, but has a huge impact on how funds are managed around the world. So kudos on that. But you also have a part that also measures kind of customer service or member services or whatever. And so when I read the report, yes, it makes sense to amalgamate smaller funds from an investment perspective. But what then happens to their customer service side, and leads to the question, is there any ability to aggregate that as well, so that I, as a small fund, can, a small pension plan can in effect outsource both the investment side and the customer service side?
Yeah, absolutely. And so the number is actually so we studied this, and the number is 63%. For every tenfold increase in members, you see your average cost to serve those members decrease by just over 60%. And it's driven, and I found this actually quite interesting because it was actually driven, I thought it was going to be more technology. Like you have more IT, you spread it across all your technology across a larger number of people. It's actually not. The larger funds actually have more sophisticated and customized systems that require more IT spend. It's actually governance, back to an important point we made earlier, in all of your support functions. And so you actually do see significant scale benefits in the way you serve your clients on the member side as well. That actually dovetail very nicely with the investment side we've talked about. And Jim, I'm going to sneak in one quick thing just before, because I think this might be the last question I get to answer. I just wanted to call out the team at CEM who did the research. Chris Flynn, Alex Beath, Mike Reed. I just want to make sure they're thanks for all the great work they've done in putting all of this together.
Good, super. Bert, any comments on that?
But yeah, I also thank them. A tremendous piece of work, and as Rashay said earlier, hopefully this is the start by getting the facts out there and giving fiduciaries an opportunity to look and consider it, that they now recognize there are options here to increase enhanced returns that are risk neutral, maybe even risk reducing. And those require consideration.
And I'd like to, before I turn it back to you, Colleen, sort of address one thing that came up that you said, Bert, and you emphasized, Rashay, and that is governance. Certainly, when I was in the industry, if we looked across the world as to who were the best performers, and what was the secret sauce in the Canadian model, it was governance, and that governance which allowed you to be free of any political interference, allowed you to hire the right people, allowed you to delegate authority, and to have a knowledgeable, professional group who are responsible fiduciaries on your board of directors. And that is the winning formula. So Colleen, thank you very much for hosting this conversation. Back to you.
Thank you so much, Jim, and thank you all for that great conversation. Bert and Rashay, thank you again for joining us today. We appreciated the discussion on the challenges that smaller funds are facing in delivering on their financial obligations to Ontarians and some of the solutions to overcome them, and how we can share this knowledge with the whole world and help make the world a better place just right here. So thank you so much. We also thank you and your team's dedication to Ontario and making today's event so insightful and successful. We had so many questions. Thank you, Jim, for trying to fit them all in, and your expert guidance of the discussion today. And once again, I want to thank Stikeman Elliott for their generous support of today's event, and our AV supplier, Van Valkenburg Communications and LiveMeeting.ca, for making it possible for us to gather virtually today. And I hope maybe you'll help join us for some of our upcoming events. Tomorrow, we host the Honorable Seamus O'Regan, the Federal Minister of Labour, for a discussion on the government's plan to support workplace mental health and position Canada for a strong recovery post-pandemic. And on February 15th, we have a celebration of Black creativity, leadership, and Black agency, featuring some of Canada's most accomplished leaders: Alika Hall from the NIA Centre for the Arts, Charlene Theodore, the Chief Inclusion Officer of McCarthy Tetro, and Ray Williams from National Bank Financial. We're really excited about that conversation, so I hope you'll join us then. To learn more about our upcoming events, explore our newly designed website at canadianclub.org, browse our rich archive of past events, and check out our new updated membership categories. Please consider becoming a member to support our club's work and our continued conversations that matter. So, guests, thank you for joining us today. Please stay healthy and safe. Thank you again, Bert, Rashay, and Jim.